Hello, friends. Welcome back to the channel. Today, we're going to dive into one of the most insightful books on trading, High Probability Trading by Marcel Link. Now, whether you're a seasoned trader or just starting, this book is packed with valuable lessons that can take your trading to the next level. It's not just about learning strategies or crunching numbers. What makes this book special is that it focuses on developing the right mindset, staying disciplined, and understanding the psychological side of trading. Marcel Link shares practical advice on how to make smarter, high-probability trades and avoid common mistakes that can cost you big. If you're ready to sharpen your trading skills, understand the core of high-probability trading, and learn what truly drives successful traders, make sure you like, share, and subscribe. That way, you won't miss out on future content that will help you succeed in the markets. All right, let's jump in. What is high probability trading? Welcome to the world of high probability trading, where success isn't about luck, noise, or constant action, but about patience, preparation, and precision. Marcel Link sets the tone with a powerful truth. Most traders lose money not because the market is unfair, but because they don't approach it like professionals. High probability trading isn't about getting rich overnight. It's about learning to play the game smartly and giving yourself the best possible chance to win. Link starts by pointing out the brutal reality that the majority of traders fail. They come in with dreams, with adrenaline, and often with egos. They believe trading is easy, just a few hours a day, click a few buttons, and the money flows in. But as Link makes clear, the market doesn't reward dreams. It rewards discipline. It rewards preparation. It rewards those who are patient enough to wait for only the best setups, the trades that have a high probability of working out. So what exactly is a high probability trade? It's not a guaranteed winner. That doesn't exist. It's a trade that stacks the odds in your favor. Think of it like a poker hand. The professional trader, like the professional card player, doesn't play every hand. They fold most of the time. But when the odds line up, when the setup is just right, they go in with conviction. In trading, that means choosing only those moments when your technical signals, your market understanding, and your risk-reward ratio are all pointing in the same direction. But Link warns, many traders can spot those setups, yet still lose money. Why? Because they're not mentally ready. They don't follow rules. They overtrade. They panic. They cut winners short and let losers run. That's where the deeper message of this chapter comes in. High probability trading is just as much about your behavior as it is about your strategy. Marcel Link insists that if you want to succeed, you have to think like a professional. That means approaching trading like a business. You need structure. You need goals. You need a plan. And above all, you need to stop treating the market like a game. He explains that the market doesn't care about your needs. It doesn't owe you anything. Whether you're having a good day or a bad one, the market keeps moving. The only thing you can control is your process. You can't force the market to give you profits, but you can control when you enter, how much you risk, and when you get out. Another powerful idea Link introduces in this chapter is the importance of being wrong. Yes, being wrong. Because being a trader doesn't mean always being right. It means managing your risk when you're wrong and maximizing your returns when you're right. It's about long-term survival and long-term profits, not instant gratification. He also touches on the emotional traps that ruin most traders: overconfidence, fear, greed, and revenge. These emotions cloud judgment and lead to poor decision-making. That's why high-probability trading also demands emotional control. You have to be okay with missing trades. You have to be okay with losses. And you have to trust your system even when it's not giving immediate rewards. What makes a trader good? So what really separates a struggling trader from a consistently profitable one? Marcel Link peels back the curtain on what it truly means to be a good trader. And here's the surprise. It's not about intelligence, background, or how many screens you have blinking in front of you. It's about character. It's about mindset. And above all, it's about how you behave under pressure when real money is on the line. Link starts by pointing out a painful truth. Most traders jump into the market thinking it's about mastering a strategy or understanding charts. But those things are only half the battle. The real war is internal. Good traders, he says, are not those who never make mistakes. They're the ones who learn from them. They adapt, evolve, and stay humble even when they're right. Discipline sits at the top of Link's list. A good trader follows their plan, not their gut. They don't break rules just because this one trade feels different. They know that consistency only comes from process. Discipline means waiting for the right setup, entering the trade with proper risk parameters, and exiting according to plan, not emotion. It's not sexy, but it works. Patience comes next. Most people lose because they're constantly trying to make something happen. They force trades when the market isn't offering much. But good traders understand no setup is better than a bad setup. They're like snipers, not machine gunners, waiting for that one clean shot where the odds are stacked in their favor. And if the market's not showing anything, they're fine sitting out. Link also stresses the power of emotional control. The market is a master manipulator. It tests your fear, your greed, your confidence, and your doubts. A good trader knows how to stay centered. They don't chase a missed trade out of frustration, and they don't double down on a loser trying to be right. They take losses gracefully. They celebrate wins modestly. They never let emotions hijack their decision-making. One of the most admirable qualities Link points out is accountability. Good traders own their results. They don't blame the market, the news, or their broker. If they made a mistake, they look in the mirror and learn from it. Every loss becomes a lesson. Every error becomes feedback. They grow stronger because they're not afraid to face their flaws. Another key trait? Humility. The market humbles everyone eventually, and those who think they can outsmart it usually don't last. Good traders respect the uncertainty. They never assume they're smarter than the market. Instead, they use tools, patterns, and experience to give themselves an edge, but they're always ready for things not to go their way. That's the mindset of a survivor. Then comes adaptability. The market changes. Strategies that worked yesterday might fail tomorrow. A good trader doesn't get married to a method. They're constantly observing, tweaking, and evolving. They know that rigid thinking is dangerous in a fluid environment. Link also highlights the importance of consistency. You don't need home runs. You need base hits. It's not about one great week. It's about showing up, executing your edge, and repeating that process over and over. A good trader builds habits that lead to steady returns, not roller coaster results. In a world where most traders blow out because they lack self-awareness, discipline, or emotional control, Link reminds us that the edge isn't always in the charts, it's in your behavior. The market rewards those who treat it like a profession, not a game. The tuition of trading. Marcel Link delivers a hard but necessary truth. Losses are part of the learning process. And in the trading world, these losses are what he calls the tuition we pay to the market in exchange for a real education. At the heart of Link's message is a powerful mindset shift. Most new traders come into the market expecting to make money right away. They think a few books, a couple of indicators, and some demo practice are enough to start earning real profits. But the market doesn't work like that. It's not a place that rewards wishful thinking. It rewards experience, discipline, and psychological strength. And that experience almost always comes with a price: losing trades. Marcel compares learning to trade with becoming a doctor or lawyer. No one becomes a professional overnight. It takes years of study, practice, and real-world experience. The same applies to trading, but with one key difference. Instead of paying tuition to a school or university, you pay it directly to the market. He shares his own experience of losing money during the early years. Not just a few trades, but a lot of them. And it hurt, emotionally, financially, and mentally. But what made the difference wasn't avoiding losses, it was how he responded to them. He chose to learn. He began asking the right questions. Why did this trade fail? What rule did I break? How could I have managed risk better? This is where real growth begins. Link warns new traders not to expect smooth sailing. The first year, maybe even the first few years, can be brutal. And if you're not prepared to handle that financially and emotionally, you're going to struggle. This is why he emphasizes the importance of starting small. Don't risk your life savings. Don't borrow money to trade. Think of this phase as your internship. You're not here to get rich yet. You're here to learn how not to lose. One of the most important concepts he shares in this chapter is the value of every mistake. In the beginning, every blown stop, every rush trade, every moment of hesitation is a teacher, but only if you take time to reflect. Marcel urges traders to journal their trades, track their decisions, and ask themselves what they could have done better, not just technically, but emotionally and strategically. This self-reflection turns losses into lessons. He also reminds us that even the best traders still take losses. It's part of the business. The key difference is that professional traders control those losses. They use stops, size their positions properly, and never risk more than they can afford to lose. Losing trades are expected. What matters is that the wins are bigger than the losses over time. Another strong message Marcel delivers is this: if you're not willing to lose, you're not ready to trade. If every red trade breaks your confidence, or if you feel the need to get back to break even immediately, you're emotionally unfit for the market. The goal isn't to avoid losses, it's to lose intelligently. That's what makes a trader durable. He also tackles the ego problem. New traders often see losses as personal failures. But the market isn't personal. It doesn't care who you are or how badly you need the money. The sooner you stop tying your identity to your trading performance, the better decisions you'll make. Losses are not the end of the world. They're the beginning of your education. They're the price of admission to the game of trading. And if you treat them as teachers instead of enemies, you'll emerge wiser, stronger, and better prepared for the long haul. So yes, trading has a tuition, but if you pay it mindfully, the returns in knowledge, discipline, and future profits can be worth every penny. Setting realistic goals. Marcel Link tackles one of the biggest psychological traps in trading: unrealistic expectations. Many new traders walk into the market with dreams of getting rich fast. They see stories of traders making thousands in a day, quitting their jobs, and living the dream. But as Marcel bluntly reminds us, that mindset is dangerous. Trading isn't a lottery. It's a business. And like any real business, it needs structure, patience, and time to grow. That's why setting realistic goals isn't just helpful. It's critical to surviving long enough to succeed. Link starts by asking a very practical question. If you were starting any other business, would you expect to be wildly profitable in your first few months? Of course not. Most businesses take time to become sustainable. You plan, you test, you improve. Trading should be no different. And yet, many beginners expect consistent income right away, sometimes without even having a strategy that works. The key, he says, is to shift your mindset from chasing profits to building process. In the early stages, your goals shouldn't revolve around how much money you want to make. They should focus on things you can actually control, like following your plan, limiting your losses, and making fewer emotional decisions. Link encourages traders to start with performance-based goals rather than outcome-based goals. For example, I will follow my stop-loss rules on every trade this week. I will journal every trade and review it nightly. I will not take trades that don't meet all my criteria. These goals may not sound exciting, but they build the discipline and habits that lead to long-term success. And more importantly, they give you tangible victories, even when your equity curve isn't skyrocketing. Another strong point Marcel makes is about consistency. If your goal is to be profitable, you must first be consistent in your actions. The market rewards traders who behave consistently, not those who jump between strategies, chase trades, or let emotions guide decisions. He also warns against setting goals that are too aggressive, especially early on. For instance, trying to double your account in a month will likely push you into overtrading, taking oversized positions, or holding on to losers too long, all of which are recipes for disaster. Instead, Link suggests framing goals in a way that keeps pressure low and focus high. Think long-term. Focus on survival and improvement. If you can protect your capital while learning and refining your skills, the profits will follow. Marcel also speaks to the importance of patience. Good trades don't appear every minute, and real growth doesn't happen overnight. That's why many traders burn out. They set impossible targets, fall short, and then feel like failures. But if your goal is simply to get a little better each week, to lose a little less, or to stick to your rules a little more, then you're always making progress, even during tough market conditions. There's also a powerful reminder here. Trading is a marathon, not a sprint. If you aim for slow, steady improvement, month after month, you'll end up far ahead of the crowd. But if you chase instant success, you'll likely flame out before you even build a solid foundation. Set goals that reflect where you are now, not where you wish you were. Trade to improve, not just to win, because in the end, it's the small, consistent steps that build big, lasting success. Leveling the playing field. Marcel Link shifts the spotlight toward the underdogs, the individual, self-taught traders, and shows them how to compete with the big players. At first glance, retail traders seem outmatched. They don't have the deep pockets, institutional research, or lightning-fast execution that professionals do. But according to Link, individual traders can level the playing field if they play smart, stay disciplined, and take advantage of modern tools and constant education. He begins by acknowledging the disadvantages that new traders face. Institutional firms have teams of analysts, direct access to exchanges, and huge capital reserves that let them absorb losses without panic. They can afford to be wrong a few times and still survive. Retail traders, on the other hand, are often trading with limited capital, limited experience, and a lot of emotional pressure. But here's the key. Professionals also have limitations. They answer to clients, they're bound by strict risk protocols, and their large position sizes can make entering and exiting trades more complex. Retail traders, with smaller positions and more flexibility, actually have an edge in certain situations, if they know how to use it. Marcel stresses that technology has been the great equalizer. Today, anyone with a decent computer, a strong internet connection, and quality charting software can access the same data that professionals use. Real-time quotes, advanced technical analysis tools, and market scanners are now widely available. And many of these tools don't require institutional access. They're sitting on your desktop, just waiting to be understood and used correctly. But technology alone isn't enough. The real secret weapon? Education and mindset. Link is passionate about self-study. He urges traders to become obsessive learners, to read books, track trades, review charts, and study their own mistakes. He emphasizes that no one ever becomes successful by accident. The best traders got there by treating the craft seriously, almost like an Olympic athlete would. Not just trading here and there, but studying market behavior, analyzing entries and exits, and always asking the hard questions. Why did this trade work? Why did that one fail? He also touches on the importance of developing a routine. Professional traders show up to work the same way every day. They don't wing it or trade on gut feeling. Retail traders must adopt the same structured mindset. That means having a trading plan, reviewing pre-market data, sticking to a strategy, and tracking every trade like a scientist tracking experiments. Another powerful point Marcel makes is that professionals are not invincible. They make mistakes. They blow trades. In fact, many institutional traders are simply average performers with good discipline. What separates them is consistency. So if a retail trader can build consistency through practice, record keeping, and emotional control, they already have what it takes to stand alongside the pros. Link also reminds us that retail traders don't have to impress anyone. They can focus on growing slowly, risking less, and taking only the best setups. Unlike professionals who are often pressured to do something to justify their salaries or manage client expectations, independent traders can sit on their hands until the right moment comes. That patience, ironically, becomes a major edge. Trading the news. In this chapter, Marcel Link dives deep into one of the most volatile aspects of trading, news events. He opens with a clear warning. Trading around news is not for the faint of heart. It's fast, it's unpredictable, and if you're not prepared, it can wipe you out in seconds. But if you understand how news affects the markets and you approach it with caution and strategy, it can also present some of the most powerful trading opportunities. News is one of the few things that can truly move the market dramatically in a short amount of time. Whether it's economic data, earnings releases, geopolitical events, or central bank announcements, traders react swiftly and sometimes irrationally to new information. Link emphasizes that understanding this behavior is key to surviving and thriving during news-driven moves. He explains that there are two major categories of news: scheduled and unscheduled. Scheduled news like employment numbers, GDP reports, or Federal Reserve meetings gives traders time to prepare. You know when it's coming, and you can either decide to position yourself ahead of the release or step aside and wait for the dust to settle. Unscheduled news, like terrorist attacks, natural disasters, or surprise corporate announcements, is more dangerous because it catches the market completely off guard. In these moments, volatility explodes and panic often takes over. Marcel makes it very clear. Most retail traders should not try to predict the outcome of news events. That's a gamble, not a strategy. The smarter approach is to watch how the market reacts after the news is out. Often, the initial move is a knee-jerk reaction, driven by emotion. But soon after, the market begins to process the news logically. That's where disciplined traders can find high-probability setups. He shares a practical example. Let's say an earnings report comes out stronger than expected and the stock shoots up. At first, the move might be sharp and overdone, but as volume increases and the price pulls back slightly, a base may form. That could be a better, safer entry point when the market has digested the news and the momentum is still intact. Link stresses the importance of knowing the news calendar. Every trader should be aware of major events before entering a trade. If a big announcement is scheduled within the hour, it's often wiser to stay flat. Otherwise, even the best technical setups can be torn apart by a sudden price spike caused by new information. He also warns against trading based on your personal interpretation of the news. Just because a number looks good doesn't mean the market will rally. Sometimes the market reacts the opposite way due to expectations already being priced in. This is why Link strongly advises to never trade the news based on logic alone. Trade the reaction, not the headline. Another point he makes is that news moves can create traps. A stock may surge higher after news, triggering buy orders and stop losses, only to reverse sharply and leave late buyers stranded. That's why timing and patience are crucial. Jumping in too early can be costly. Waiting for confirmation, like a breakout holding above resistance or a pullback that finds support, often leads to better results. News trading requires lightning-fast decision-making and emotional control. If you're not yet confident in your ability to react under pressure, it's better to sit on the sidelines and observe. There's no shame in protecting your capital. Increasing your chances with multiple timeframes. Marcel Link introduces one of the most practical tools for traders aiming to improve their accuracy: multiple time frame analysis. He makes a compelling case. If you want to become a consistently profitable trader, you simply can't afford to trade by looking at just one chart. You need a broader perspective to see the full story the market is telling. Link begins by explaining the core concept. Different time frames reveal different kinds of information. If you're a day trader staring only at a 1-minute or 5-minute chart, you're watching short-term noise. But if you zoom out to a 15-minute, hourly, or daily chart, you'll begin to see the actual trend. It's like comparing a single puzzle piece to the full image on the box. One gives you detail, the other gives you context. He warns that traders who rely solely on one time frame often fall into traps. They may think a setup looks perfect, say, a bullish breakout on a 5-minute chart. But what they don't realize is that on the hourly chart, the price is actually running right into strong resistance. Without the bigger picture, they're walking blind into danger. Marcel encourages a top-down approach. Start with the longer time frame to identify the overall trend. Are we in an uptrend, downtrend, or a range? This sets the tone for the types of trades you should look for. Once that's clear, move to a medium-term chart to spot setups forming. Finally, use the shorter time frame to time your entries and exits with precision. For example, if the daily chart shows an uptrend and the hourly chart reveals a pullback to support, then the 5-minute chart can be used to find the exact entry when momentum returns. When all time frames line up in agreement, that's when you have a high probability trade. He also emphasizes how this approach keeps you aligned with the market's rhythm. Many beginner traders try to go against the larger trend just because the short-term chart looks tempting, but those trades rarely last. Link reminds us, it's much easier to go with the tide than to swim against it. One powerful insight he shares is how multiple timeframes help you stay patient and avoid impulsive trades. By waiting for alignment across timeframes, you filter out mediocre setups. You're not chasing every minor signal, you're waiting for clarity. This not only increases your win rate, but also reduces emotional stress. You're not forcing trades, you're selecting them. Link also talks about the flexibility this method offers. Whether you're a scalper, a swing trader, or even a position trader, using time frame analysis can be customized to your style. A swing trader might look at the weekly, daily, and 4-hour charts. A day trader might stick to the hourly, 15-minute, and 3-minute. The idea isn't to follow a fixed formula, but to use layers of information to make smarter, more confident decisions. He closes the chapter by reinforcing a simple but powerful principle. The more confirmation you have, the better your odds. And multiple timeframes are a great way to gather that confirmation. When you see the same setup playing out across different charts, it's like having multiple witnesses all pointing to the same truth. So the next time you're tempted to jump into a trade based on just one chart, pause. Zoom out, look again. Ask yourself, is this setup aligned with the bigger picture? Or am I about to step into a trap I could have seen coming? Because in the world of trading, seeing more means risking less, and that's how you trade with high probability. Trading with the trend. Marcel Link tackles one of the most fundamental principles of trading, the importance of trading with the trend. He lays out the simple but powerful idea that trading in the direction of the prevailing trend gives traders a significant advantage. But despite how simple this concept sounds, it's one of the most commonly overlooked or ignored strategies by inexperienced traders. Link starts by defining what a trend is. In its simplest form, a trend is simply the direction in which the market is moving. It could be an uptrend, where the price is making higher highs and higher lows, or a downtrend, where the price is making lower highs and lower lows. There's also the possibility of the market being in a sideways range, but for the purposes of this chapter, we'll focus on the importance of identifying clear directional moves. He quickly underscores a major mistake many traders make: fighting the trend. Too often, traders, especially beginners, become overly eager to predict reversals. They'll spot a strong price move in one direction and think the market is overdue for a change. This leads them to take counter-trend trades, betting that the trend will reverse when, in fact, it often continues to power in the same direction. Link refers to this as picking tops and bottoms, and he points out that this is one of the fastest ways to lose money. Instead of trying to predict reversals, Link advises traders to go with the flow. The market has a natural rhythm, and when you trade in sync with that rhythm, your odds of success increase dramatically. The idea is to ride the trend, whether it's up, down, or sideways, until there are clear signs that the trend is losing steam or reversing. One of the key advantages of trading with the trend, according to Link, is that it's often easier to find entries and exits when you're working with the prevailing momentum. In an uptrend, for example, you'll typically find support at higher levels, and in a downtrend, resistance will form at lower levels. These established areas give traders clear points to enter or exit positions. Marcel uses a practical analogy to drive the point home. Imagine rowing a boat. If you row with the current, trend, you'll move faster and cover more distance with less effort. But if you row against the current, it becomes incredibly difficult and tiring. Similarly, trading with the trend allows you to ride momentum and enjoy smoother, more predictable moves. Link also discusses the significance of trend confirmation. To really confirm that you're trading with the trend, it's essential to look at multiple timeframes. For instance, if the daily chart shows an uptrend and the hourly chart confirms that the price is making higher highs and higher lows, that gives you more confidence that your trade aligns with the larger market direction. This method increases the likelihood of a successful trade because you're not just looking at a single time frame in isolation. Moreover, he highlights that trading with the trend minimizes the emotional strain on traders. When you're trading against the trend, you're constantly battling the market's natural direction, which increases the emotional toll of your trades. But when you align yourself with the trend, trades feel more natural, your confidence improves, and the emotional stress is greatly reduced. Link also emphasizes patience as a key factor in successful trend trading. It's easy to get impatient when the market seems to be moving slowly, but jumping in too early or too late can be dangerous. Waiting for clear trend confirmation and then patiently waiting for the best entry points will put you in a much better position to succeed. Using oscillators. Marcel Link dives into the use of oscillators, a type of technical indicator that traders can use to measure market momentum and identify overbought or oversold conditions. These indicators are critical for assessing whether an asset is being overbought or oversold, which can help traders pinpoint potential reversal points or areas of price congestion. Link starts by explaining that an oscillator is a tool that fluctuates between a fixed range, typically from -0 to 100. These indicators are often used in conjunction with other forms of technical analysis to get a clearer picture of the market's strength or weakness. The main focus of oscillators is to highlight extreme conditions, whether the market has overextended in a particular direction and might be due for a correction, or if it's underextended and may be ready to make a move in the opposite direction. The two most commonly discussed oscillators in this chapter are the Relative Strength Index, RSI, and the Stochastic Oscillator. Let's break them down. RSI, Relative Strength Index. Link starts with the RSI as one of the most widely used oscillators in trading. The RSI measures the speed and change of price movements on a scale of 0 to 100, with readings typically above 70 Cs, indicating that the market is overbought, and readings below 30, signaling that the market is oversold. Link emphasizes that the RSI should not be used in isolation, but rather as part of a broader strategy. Overbought or oversold conditions do not automatically mean that a market is about to reverse. Sometimes a market can stay overbought or oversold for extended periods, especially during strong trends. However, divergences between price and RSI, i.e., when the price makes a new high or low, but the RSI doesn't follow, can signal that the trend is losing momentum and a potential reversal is in the works. He gives a useful piece of advice. Don't chase extreme readings. For example, just because the RSI is above 70 doesn't mean the market is immediately going to reverse. Instead, Link suggests waiting for confirmation from other indicators or price action before acting. Stochastic Oscillator. The next tool Link covers is the Stochastic Oscillator, which is similar in concept to the RSI but slightly more advanced. The Stochastic Oscillator compares a specific closing price to the range of prices over a set period of time. This gives traders a clear indication of where the current price stands relative to its recent high-low range. The Stochastic Oscillator also ranges from 0 to 100 drill, and readings above 80 indicate overbought conditions, while readings below 20 suggest that the market is oversold. However, like the RSI, it's important to remember that extreme readings in isolation don't guarantee a reversal. The key to using the stochastic oscillator effectively is looking for crossovers. When the cent K line, the fast line, crosses above or below the cent D line, the slow line. Link's advice on oscillators. One of the main points Link stresses in this chapter is that oscillators are most effective when combined with other indicators and tools. He explains that no single indicator can provide a complete picture of the market. For example, oscillators are often best used in combination with price action, support-resistance levels, and trend analysis. Additionally, Link advises caution when using oscillators during strong trends. Oscillators tend to be more reliable in sideways or range-bound markets, where prices swing between overbought and oversold levels. In strong trending markets, oscillators can give false signals, as the market may remain overbought or oversold for longer than expected. Finally, Link suggests that patience is key when using oscillators. Oscillators often lag behind price action, so traders should wait for confirmation of a reversal or a breakout before entering a position. This helps avoid getting caught in false signals and ensures that the trade is based on a solid foundation of market evidence. Breakouts and reversals. Marcel Link explores two of the most exciting and high-potential trading opportunities: breakouts and reversals. These are critical concepts for traders looking to catch significant market moves. But as Link emphasizes, understanding when and how to trade breakouts and reversals is an art that requires careful attention to market conditions, a solid strategy, and the ability to wait for confirmation. What is a breakout? Link begins by defining a breakout as a price movement where the market moves past a key level of support or resistance. It signals a change in market sentiment, often leading to large, sustained price movements. The key to trading breakouts successfully is recognizing the setup before the breakout occurs, rather than jumping in too early or too late. Link emphasizes that not all breakouts are created equal. A breakout that happens on high volume with strong follow-through is far more reliable than a breakout that happens on low volume or with little price action afterward. This is why it's essential to wait for confirmation that the breakout is real and not just a fake out, where price breaks through a level only to return right back to where it started. Link also shares a critical piece of advice: never chase a breakout. Many traders are eager to get in as soon as a breakout happens, but Link advises waiting for the market to confirm that it's really moving in the breakout direction before jumping in. For example, if the price breaks out above resistance, wait for a pullback or consolidation before entering to avoid entering a trade that may reverse. Breakout strategies. One breakout strategy Link mentions is to look for price consolidation at key support or resistance levels. When the market has been trading sideways for a while, it builds up energy, and eventually it breaks free in one direction or the other. Recognizing these consolidation periods and waiting for the breakout can give traders an edge in capturing significant moves. Reversals, the opposite of breakouts. While breakouts focus on momentum, reversals are all about price action signaling that a trend is coming to an end and is about to turn in the opposite direction. Reversals can be highly profitable, but they're also trickier to identify. Traders need to be able to spot the signs that a trend is losing steam before jumping in. Link explains that reversal trades are often the most profitable because they capture the early stages of a new trend. However, the key challenge is distinguishing a true reversal from a retracement, which is simply a temporary pause within an existing trend. To identify a true reversal, Link stresses the importance of market signals, such as price patterns, candlestick formations, and divergences between price and indicators like the RSI or stochastic oscillator. For example, a double top or double bottom pattern often signals a potential reversal, as does a head and shoulders pattern. Reversal strategies. One strategy Link uses to identify reversals involves looking for divergences between price and momentum indicators. If the price makes a new high, but the indicator, like RSI, fails to reach a new high, this could signal weakening momentum and a potential reversal. Similarly, if the price makes a new low, but the indicator does not, it can indicate that selling pressure is drying up and a reversal may be imminent. Patience and confirmation. One of the most critical themes Link emphasizes throughout this chapter is the need for patience and confirmation. Whether you're trading a breakout or a reversal, the key is not to rush in based on a hunch or a single indicator. Wait for price action to confirm the move before committing to the trade. This prevents getting caught in false breakouts or reversals, which are common in the market. Link also highlights the importance of risk management when trading breakouts and reversals. Because these setups can sometimes lead to rapid market moves, it's crucial to protect your capital by using stop-loss orders and adjusting position sizes accordingly. By practicing these techniques, traders can position themselves to profit from some of the most significant moves in the market, ultimately leading to more consistent and profitable trades. Exits and stops. Marcel Link emphasizes one of the most crucial aspects of successful trading: managing risk. More specifically, he focuses on exits and stop-loss orders, both of which are vital for ensuring that traders can protect their capital and avoid catastrophic losses. In the world of trading, the risk of loss is inevitable, but the key is to minimize it through smart, predetermined exit strategies and stop-loss techniques. The importance of exits and stops. Link starts by discussing a hard truth. Every trade has the potential to go wrong. No matter how well prepared or confident you are, trades can turn against you at any moment. Therefore, having a clear exit strategy is non-negotiable. It's not enough to simply know when to enter a trade. You must also know exactly when to exit, whether you're taking a profit or cutting a loss. Exits are just as important, if not more important, than entries. Link emphasizes that the absence of a predetermined exit strategy is one of the most common reasons why traders experience significant losses. It's easy to get caught up in a trade and let emotions take over, especially when the market moves against you. A lack of discipline in exits often leads to allowing small losses to grow into large ones. Having a clear exit strategy defined before the trade even starts helps to eliminate this emotional element. Setting stop-loss orders. One of the cornerstones of Link's risk management advice is the use of stop-loss orders. A stop-loss order is a predetermined point at which a trader will exit a position to limit losses. Setting a stop-loss is essential because it forces traders to cut their losses early, rather than letting a trade go against them, hoping it will eventually turn around. Link stresses that hope is not a strategy. The stop-loss should be set according to market conditions, not based on arbitrary numbers or a trader's personal comfort zone. Link explains that stop-losses should be wide enough to accommodate normal market fluctuations, but not so wide that they expose the trader to unnecessary risk. Ideally, a stop-loss should be set just beyond a key level of support or resistance, where a break in price would invalidate the trade idea, the discipline of exiting a trade. While setting a stop-loss is essential, exiting a trade is equally important. Link talks about two types of exits. 1, the exit based on a loss, the stop-loss. 2, the exit based on a profit target. Most traders are good at identifying potential profit-taking levels, but many traders fail to manage their losses properly. Link advises that you should never let a small loss turn into a big loss. If the market hits your stop-loss, you need to accept it and move on. The same goes for profits. If the market hits your target, you should take the profits and exit without second-guessing. Link suggests that you plan your exit before entering the trade. This means having a set exit point for both profit-taking and loss-cutting. Traders who don't plan their exits often end up holding on to losing trades, hoping that things will improve, only to see their losses increase. The idea is to make your trading decisions in advance, rather than reacting emotionally in the moment. The role of trailing stops. Another important tool discussed in this chapter is the trailing stop, which Link highlights as a powerful way to lock in profits. A trailing stop moves with the price, maintaining a set distance between the market price and the stop order. As the market moves in the trader's favor, the stop moves with it, securing profits if the market reverses. This allows traders to ride the trend while protecting themselves from giving back profits in case of a market reversal. Link points out that trailing stops should be used with care. They work best in trending markets, but can be ineffective in sideways or range-bound markets, where prices tend to fluctuate without clear direction. The 1-to-1 risk-to-reward ratio. Link introduces the concept of the 1-to-1 risk-to-reward ratio, emphasizing the importance of balancing risk and reward. For every trade, you should know how much you are willing to risk, the stop loss, and what potential reward you're targeting, the profit-taking point. If the risk-to-reward ratio isn't favorable, it's best to pass on the trade. In his view, consistently profitable traders know how to manage risk by setting reasonable stop-loss levels and realistic profit targets. Making the high-probability trades. Marcel Link dives deep into the concept of high-probability trading, the art of identifying and executing trades that offer the best risk-to-reward ratios. For a trader, it's not just about making a lot of trades. It's about making the right trades at the right time. Link explains that success in trading comes not from a high number of trades, but from a small number of high-quality trades. The foundation of high-probability trades. The chapter begins by explaining that high-probability trades are those that have a greater chance of success due to clear and well-defined market conditions. These trades are based on setups that have a favorable risk-to-reward ratio. In other words, a high-probability trade is one where the potential reward significantly outweighs the risk you are taking on. Link stresses that identifying high-probability setups is the first step in achieving trading success. However, finding these setups requires discipline and patience. Too many traders jump into the market without a solid plan, hoping for quick profits. But the truth is, high-probability trades require time to develop. They don't just appear out of nowhere. They need to be nurtured and recognized based on certain market conditions. The role of patience and discipline. Link emphasizes that patience is critical when it comes to making high-probability trades. Instead of trading every time you see a potential setup, you need to wait for the optimal conditions. High-probability setups are not about taking advantage of every small movement in the market. They're about waiting for the market to align with your strategy. And this requires patience. Discipline plays an equally important role. It's easy to get tempted by the market's movements, especially when you're seeing other traders making quick profits. However, Link insists that successful traders stick to their plan. They don't chase after every market move. Instead, they execute only when the setup fits their criteria. This discipline ensures that only the best trades are taken with the highest probability of success. Risk-to-reward ratio, a key indicator. One of the central themes in this chapter is the risk-to-reward ratio, which is a critical factor in determining the quality of a trade. Link explains that the risk-to-reward ratio tells you how much potential profit you can make for every dollar you risk. For example, if you're risking $100 to make $300, the ratio is 1/3, which is considered excellent. Link advises that a 1-2 risk-to-reward ratio should be the minimum standard. Anything less than that, and the trade becomes too risky. The key is that traders must be disciplined in sticking to a favorable risk-to-reward ratio. Even if a trade has a high probability of success, a poor risk-to-reward ratio can lead to losses over time. The long-term goal is to consistently win more than you lose, and the only way to achieve that is by ensuring that each trade has a good risk-to-reward balance. Identifying the right setup. In order to identify high-probability setups, Link stresses the importance of relying on technical analysis and market structure. For example, key support and resistance levels, price patterns, and indicators such as moving averages or RSI are useful tools for spotting the right trade opportunities. However, Link emphasizes that it's not just about looking for these patterns in isolation. You need to consider market context and confluence, which is when multiple indicators or signals line up to confirm a trade. For example, if price is at a strong support level, the RSI shows oversold conditions, and a candlestick pattern signals reversal. That's a high probability setup. Executing the trade with precision. Once a high probability setup is identified, Link outlines the importance of executing the trade with precision. This means entering the trade at the right price and managing the trade carefully with stop-loss orders, risk management strategies, and exit points. Link also talks about the necessity of controlling your emotions during the trade. Emotional trading is one of the biggest reasons traders fail. Even with a great setup, if emotions like fear or greed take over, you may exit the trade too early or hold on to it for too long. Following the plan is crucial to executing high-probability trades successfully. The trading plan and game plan. Marcel Link emphasizes the significance of having a structured plan for trading. He breaks down the essentials of creating both a comprehensive trading plan and a daily game plan, both of which are key to ensuring consistency and discipline in your trading practice. Link stresses that without these plans, traders are flying blind, which is a recipe for failure in the markets. The importance of a trading plan. Link starts by explaining that a trading plan is your roadmap to success in the market. It should lay out your goals, strategies, and the rules that govern your trading decisions. The plan includes how you will enter and exit trades, how you will manage risk, and what metrics you'll use to assess your performance. It is essentially a blueprint that helps you navigate the ups and downs of trading without getting lost or emotionally swayed by market fluctuations. Link notes that without a trading plan, traders often get caught up in the heat of the moment, making impulsive decisions. These emotional trades can lead to losses and inconsistency, which undermines long-term success. A solid trading plan, on the other hand, allows traders to stay focused on their strategy, ignoring distractions and sticking to the rules. It helps you avoid emotional reactions to the market and forces you to trade based on logic and analysis, rather than fear or greed. Components of a trading plan. Link discusses the key components that make up a solid trading plan. 1. Trading goals. It's essential to set clear, measurable goals that are realistic and achievable. These could be focused on profitability or skill development, but they need to be specific. Without goals, traders can easily lose track and end up making decisions that don't align with their long-term objectives. 2. Risk management. A comprehensive trading plan includes well-defined risk management strategies. This covers how much capital you are willing to risk on each trade, setting stop-loss levels, and using position sizing effectively. The goal is to ensure that no single loss will wipe out a significant portion of your capital. Risk management helps you survive the inevitable losing streaks that come with trading. 3. Trade setups. Your plan should outline the specific conditions under which you will enter trades. These conditions should be based on technical indicators, chart patterns, or market conditions. The more precise your entry rules, the better your chances of success. 4. Trade evaluation. A trading plan should also specify how you will assess the outcome of each trade. Will you evaluate based on profit loss, or also consider whether the trade followed your strategy? This evaluation helps identify areas for improvement and ensures that you're learning from both your successes and mistakes. Creating a daily game plan. While the trading plan is a long-term document, the daily game plan focuses on the shorter term. Link describes the game plan as a daily checklist that you use to prepare for the trading day. This plan should outline your objectives for the day, which could include reviewing market conditions and news, identifying potential trade setups, setting specific profit and loss targets, ensuring that you're mentally prepared to execute your trades based on the rules of your trading plan. A daily game plan helps you stay organized and focused on the tasks at hand, rather than being overwhelmed by the complexity of the markets. It allows you to prepare mentally for the day's challenges, minimizing the chance of emotional decisions. Link highlights that preparation is key. When you start the day with a clear plan, you are far more likely to approach the markets with a calm and disciplined mindset. The daily game plan can also help you stay grounded by reminding you of the goals and rules you've set for yourself. Consistency and discipline. One of the most crucial elements of both the trading plan and the daily game plan is discipline. Link argues that consistency is the key to long-term success in trading, and the only way to maintain consistency is by sticking to your plan, day in and day out. He compares trading to playing a game where the rules are fixed. The more you follow your plan, the more likely you are to play successfully, and the more you deviate from the plan, the more likely you are to encounter problems. Link also touches on the importance of reviewing your game plan at the end of each day. This helps you assess whether you are able to execute according to the plan and if adjustments need to be made for future trading days. Reviewing the plan ensures that you're constantly improving and that your strategies remain effective in varying market conditions. System trading. Marcel Link dives into the concept of system trading, which is all about creating a structured, rules-based approach to trading that removes emotional biases and allows traders to make decisions based on logic and proven strategies. System trading helps traders stick to their plans, ensuring that trades are executed consistently and in alignment with their goals, rather than driven by impulsive emotions. What is system trading? System trading is essentially a methodical approach to trading, where decisions are based on predefined rules rather than gut feelings or emotional impulses. Link explains that successful trading is about making decisions that are repeatable, objective, and free from emotional interference. A system-based approach enables traders to follow a specific set of rules without second-guessing themselves, eliminating the uncertainty that often leads to poor decision-making. For a system to be effective, it must be based on sound principles and rigorous testing. This way, traders can have confidence that their strategy has been thoroughly vetted and that it works over the long term. A good trading system is designed to maximize profits while minimizing risks by taking only high-probability trades that meet the system's criteria. Why system trading works? The major advantage of system trading is that it removes human emotions from the equation. In traditional discretionary trading, traders often make decisions based on fear, greed, or the need for immediate gratification. These emotions can cloud judgment, causing traders to make impulsive trades, abandon their strategies mid-course, or even make mistakes in the heat of the moment. Link emphasizes that systematic trading helps overcome these emotional pitfalls. By following a system, traders are forced to execute trades based on logical, consistent criteria rather than emotional reactions. This is why successful system traders typically perform better in the long run, because they avoid the common mistakes that come with emotional decision-making. Building a trading system. Link explains that building a system involves several key steps. 1. Defining your criteria. The first step in creating a trading system is defining precise entry and exit criteria. What signals will you use to determine when to enter a trade? These could be technical indicators, chart patterns, or market conditions. Similarly, you need to have clear rules for exiting a trade, whether it's to lock in profits or cut losses. The key is that these criteria should be measurable and testable. 2. Backtesting the system. Once the entry and exit rules are defined, the next step is to backtest the system using historical data. This allows traders to evaluate how well the system would have performed in the past. Link stresses that backtesting is essential because it provides data-backed confidence in the system's effectiveness. However, backtesting is not foolproof, and past performance does not guarantee future results. But it does give traders a sense of whether the system has potential. 3. Risk management. A crucial part of any trading system is risk management. This includes setting stop losses, managing position sizes, and determining how much of your total capital you're willing to risk per trade. System trading should always ensure that the amount of risk is carefully controlled, which prevents the possibility of catastrophic losses due to a single trade. Risk management ensures consistency and long-term sustainability in trading. 4. Evaluating performance. Once a system is in place and running, Link advises that traders regularly evaluate its performance. This could involve analyzing trade logs, reviewing the profit-to-loss ratio, and assessing how the system has performed in various market conditions. By keeping track of your results, you can make adjustments if necessary and continually improve the system over time. Discipline in system trading. Link emphasizes that discipline is the foundation of system trading. It's not enough to simply have a set of rules. You must stick to them, no matter how tempting it may be to deviate. One of the biggest challenges for traders is sticking to the plan when things aren't going well. During losing streaks, it can be easy to feel frustrated and abandon the system in favor of better opportunities, but this often leads to worse results. By having a system in place, traders can remain committed even during tough periods. The system is designed to withstand market fluctuations, and following it through thick and thin is what leads to long-term success. Link also points out that some of the most successful system traders never make emotional decisions about their trades. They simply follow the rules and trust the system. The pitfalls of over-optimization. While creating a trading system is important, Link warns against over-optimization. This occurs when traders fine-tune their systems to fit historical data too perfectly, making them overly complex and less adaptable to real-time conditions. Over-optimization can create the illusion of a perfect system, but it often leads to poor performance in live markets due to changing market dynamics. Link advises traders to keep their systems simple and robust, focusing on principles that have stood the test of time. A system that is too complicated may look good on paper, but its performance may suffer in unpredictable market environments. A little about backtesting. Marcel Link dives deep into the concept of backtesting, a crucial process for traders looking to validate their trading systems before using them in real market conditions. Link highlights that backtesting provides traders with the opportunity to test their strategies on historical data to determine whether they are likely to work in the future. Without backtesting, traders are essentially guessing when they enter the market, which increases the risk of failure. What is backtesting? Backtesting is the process of applying a trading system or strategy to historical market data to see how it would have performed in the past. Link stresses that this process is important because it gives traders an idea of whether their strategy has real potential or if it's just a flawed idea. By applying the rules of the system to historical data, traders can evaluate how well it would have performed across different market conditions. Link emphasizes that backtesting is not just about finding good trades. It's about understanding how the system behaves over time. It allows traders to measure important performance metrics such as win rate, risk-to-reward ratio, maximum drawdowns, and profitability. This data helps traders make informed decisions on whether the strategy is worth pursuing or needs modification. The benefits of backtesting. One of the biggest benefits of backtesting is the confidence it provides. When traders can see how their system would have performed over an extended period, they are more likely to trust the system when it comes to live trading. Backtesting also helps traders refine their systems. As they test the strategy over different periods, they may discover issues or flaws that could have gone unnoticed. This allows traders to make necessary adjustments and improve the system's effectiveness. Another key benefit of backtesting is that it provides a realistic view of performance. It's easy to become overly optimistic about a trading strategy in theory, but seeing it applied to real historical data gives traders a more accurate picture of what they can expect in actual market conditions. This process helps filter out unrealistic expectations and gives traders a more level-headed approach to their trading. How to backtest a trading system. Link goes on to explain the steps involved in backtesting a trading system. 1. Define the trading rules. Before backtesting, traders must clearly define the system's entry and exit rules. These rules should be objective and quantifiable, so they can be applied consistently across historical data. Traders should also define risk management rules, like stop-loss levels and position sizes. 2. Choose the right data. Selecting the appropriate historical data is essential. Link recommends using high-quality, clean data that reflects real market conditions. This data should be as detailed as possible, including minute-by-minute or tick-by-tick information, depending on the strategy's timeframe. 3. Apply the system to the data. Once the rules and data are defined, the next step is to apply the system to the historical data. Traders can use backtesting software or even manually apply the rules to past charts, though software is much faster and more accurate. It's crucial to ensure that all trades are executed according to the system's rules, without any bias or second guessing. 4. Analyze the results. After completing the backtest, the next step is to analyze the results. Link advises traders to evaluate the performance based on key metrics like the total profit, win rate, average win, average loss, and maximum drawdown. It's important to pay attention to how the system performs in different market conditions, whether it's trending or in a range, and during periods of high volatility. Limitations of backtesting. While backtesting is a powerful tool, Link cautions that it's not a perfect method. One of the biggest limitations is the overfitting of a strategy to historical data. Overfitting occurs when a system is too tailored to past data, which may result in poor performance in real-time markets. Traders can avoid overfitting by ensuring that their strategies are robust, meaning they can adapt to changing market conditions rather than relying on specific historical patterns. Link also points out that past performance does not guarantee future results. The market is always changing, and no backtest can perfectly predict how a system will perform under new conditions. Therefore, backtesting is just one part of the process, and traders should also use forward testing and paper trading to evaluate the system's live performance. Realistic expectations and forward testing. Backtesting provides historical insight, but traders must also temper their expectations. Link urges traders to keep in mind that even the best back-tested systems will experience losing streaks and may not perform consistently in every market environment. The key is to maintain a long-term perspective and continue adjusting the system as market conditions evolve. He suggests that after backtesting, traders should engage in forward testing, where the strategy is tested in real-time markets with simulated capital. This allows traders to see how the system performs in the present moment, ensuring that it's practical and reliable. Employing a money management plan. Marcel Link delves into the critical aspect of money management, a cornerstone of successful trading. He emphasizes that no matter how well a trading strategy works, money management is what ultimately ensures a trader's survival and long-term success in the markets. A good money management plan is designed to protect a trader's capital while still allowing them to take advantage of profitable opportunities. Why money management is crucial. Link starts by stating a simple but powerful truth. You can't make money if you lose all your capital. The primary goal of money management is to preserve your capital and manage risk in a way that minimizes the likelihood of catastrophic losses. Trading without a solid money management plan is akin to gambling. Traders need a strategy to ensure that even after a series of losses, they can recover and continue trading. Link explains that most traders fail because they don't prioritize risk management. They either risk too much on a single trade or take trades without considering the potential downside. A poor money management plan can result in quick drawdowns and ultimately blow up your account. This chapter stresses that even with the best strategy, failing to manage money can lead to disaster. The role of risk-to-reward ratio. A key component of money management is the risk-to-reward ratio. Link explains that successful traders look for trades with a favorable risk-to-reward ratio, typically aiming for at least 1-day-2 or better. This means that for every dollar of risk, a trader is looking to make $2 in reward. By focusing on high-probability trades with strong risk-to-reward ratios, traders can afford to lose a few trades and still be profitable in the long run. Link suggests that even if you win only half of your trades, a 2-1 risk-to-reward ratio can lead to consistent profits over time. Position sizing. Link introduces the concept of position sizing, which refers to determining how much capital to risk on each trade. This is a critical part of money management, as it allows traders to control how much of their total account balance is at risk on any single trade. One common mistake traders make is to risk too much on each trade, which can lead to huge losses if the market moves against them. Link advises that traders should risk only a small percentage of their capital per trade, typically around 1-2% of their account balance. This ensures that even if a string of losing trades occurs, the trader's account won't be wiped out. By determining an appropriate position size, traders can ensure that they're not taking on too much risk while still allowing room for profit. The key is to find a balance between risk and reward, where the risk on each trade is small enough to allow for multiple attempts, but large enough to take advantage of profitable opportunities. Calculating stop-loss and take-profit levels. Link also emphasizes the importance of setting stop-loss and take-profit levels. A stop-loss is in order to sell a position when the price moves against the trader, ensuring that losses are capped at a predetermined level. On the other hand, a take-profit order allows the trader to lock in profits when the price reaches a specific target. The purpose of these orders is to automate the risk management process, taking the emotions out of the equation. By having predetermined stop-loss and take-profit levels, traders can avoid the temptation to hold on to a losing trade too long or prematurely exit a profitable trade. Link recommends that traders use stop-loss orders to protect themselves in case the market moves against them, and take-profit orders to lock in gains when the market is moving in their favor. By setting these levels in advance, traders are less likely to make decisions based on fear or greed. Diversification. Another key aspect of money management is diversification, which means spreading risk across multiple trades or asset classes. By diversifying, traders can reduce the impact of a single loss on their overall portfolio. Link suggests that rather than putting all capital into one trade or one type of asset, traders should consider diversifying their positions across different sectors or even different timeframes. This spreads the risk and increases the chances of success. Link also explains that diversification helps to smooth out the inevitable fluctuations in a trading account. Even if one trade doesn't perform as expected, others may perform well, helping to balance out the losses. The idea is to avoid putting all your eggs in one basket and instead build a portfolio of trades that collectively work toward long-term growth. Psychological aspects of money management. Finally, Link touches on the psychological side of money management. It's easy for traders to let their emotions dictate their decisions, especially after a loss. Many traders, faced with a losing streak, will risk more than they should in an attempt to make up for their losses. This behavior, known as revenge trading, is a common mistake that often leads to even greater losses. Link emphasizes that having a solid money management plan helps to reduce anxiety and fear in trading. By knowing exactly how much to risk on each trade and having clear rules for entering and exiting, traders can stay calm and stick to their strategy regardless of what happens in the market. Setting risk parameters and making a money management plan. Marcel Link focuses on the critical role of setting risk parameters and creating a well-defined money management plan. He underscores that successful traders don't just rely on their trading strategies. They also ensure that their risk levels are clearly defined and adhered to. Without a well-established risk management framework, even the best strategies can fail, as emotional decision-making and large, uncalculated risks can easily wipe out a trading account. Setting risk parameters. Link begins by explaining that the first step in money management is to determine the risk parameters for each trade. Risk parameters are the limits set on how much capital you are willing to risk on a single trade. This is typically a percentage of the total account balance, and Link recommends risking no more than 1 to 2% of your capital on any single trade. By doing so, traders can survive a series of losing trades without depleting their capital. Link emphasizes that determining how much risk to take on each trade requires a deep understanding of your risk tolerance. This is a personal decision, as each trader has a different comfort level with loss. Some traders may feel comfortable risking 1% per trade, while others might prefer to risk only 0.5%. It's essential to find the level of risk that aligns with your psychological makeup, as taking excessive risk can lead to emotional stress and poor decision-making. To calculate the risk per trade, you need to determine the distance between your entry point and stop-loss level. For example, if your stop-loss is 50 pips away from your entry price, and you are risking 1% of your account, you can calculate the position size based on the dollar value of that risk. Link stresses that understanding the risk-to-reward ratio is an essential part of this calculation. He suggests that traders aim for at least a 2:1 risk-to-reward ratio, meaning that for every dollar they risk, they should aim to make $2 in return. This increases the likelihood that even with a less than ideal win rate, the trader will still be profitable over the long term. Developing a money management plan. Link emphasizes that a money management plan is not just about setting risk parameters for individual trades, but also about creating a comprehensive strategy that encompasses all aspects of trading. A good money management plan integrates risk parameters, position sizing, stop loss and take profit levels, and overall portfolio management. The first component of a money management plan is to set clear goals. These goals should be specific, measurable, and realistic. For instance, rather than aiming to make as much money as possible, a trader's goal might be to achieve a consistent monthly profit of 5% with a maximum drawdown of 10%. Having a clear goal helps guide your trading decisions and provides a benchmark for success. Next, Link discusses the importance of determining position sizing. Position sizing is the amount of capital allocated to a single trade, and it should be carefully calculated based on the risk per trade and the total account balance. By using a position sizing formula, traders can ensure that they are not risking too much capital on any one trade, even if the risk is small. This allows for proper diversification and a long-term approach to growth. Risk management at the portfolio level. Link introduces the concept of portfolio-level risk management, which involves considering how each trade fits into the overall portfolio. Traders should avoid putting too much of their capital into any single position or asset class. By diversifying their trades, they can reduce the impact of a single loss and protect themselves from extreme volatility. One of the strategies for managing risk at the portfolio level is correlation analysis. Traders should assess whether the assets they are trading are correlated. If two trades are highly correlated, a loss in one may lead to a loss in the other. Link advises spreading your trades across uncorrelated assets to minimize the risk of simultaneous losses. Handling drawdowns. A significant part of risk management is handling drawdowns, the periods during which a trading account experiences a decline in value. Link acknowledges that drawdowns are inevitable in trading and that no system or trader can avoid them entirely. However, the key is to manage drawdowns in a way that they don't wipe out your account. Link suggests that traders should define an acceptable level of drawdown for their trading plan. For example, if your account experiences a drawdown of 10%, you should reassess your trading strategy and adjust your risk parameters to protect your capital. By having a plan for drawdowns, traders can stay disciplined and avoid emotional decisions when things aren't going well. The importance of discipline and consistency. Throughout the chapter, Link stresses the importance of discipline in sticking to your money management plan. Traders often make the mistake of deviating from their plan when they experience a series of losses or feel the urge to make up for previous losses. Link cautions that this behavior leads to recklessness and ultimately blows up trading accounts. He reminds traders that consistency is key to success in the long term. By sticking to your predetermined risk parameters and money management rules, you create a trading environment where success is built over time, not through short-term wins. Psychological aspects of risk management. Finally, Link touches on the psychological aspects of risk management. Traders need to remain emotionally detached from individual trades and avoid reacting impulsively to market moves. Having a well-structured money management plan helps take the guesswork out of trading, allowing traders to stay calm and focused on their long-term goals. By following a clear and consistent money management plan, traders can protect their capital, manage risk effectively, and increase their chances of long-term success. Discipline, the key to success. Marcel Link addresses a foundational concept in successful trading: discipline. He emphasizes that discipline is the linchpin that holds all the other elements of a trading strategy together. No matter how solid your strategy is, without discipline, a trader is likely to falter. Discipline is what ensures that a trader sticks to their plan, follows their rules, and doesn't let emotions dictate their trading decisions. Why discipline is vital. Link begins by asserting that discipline is the cornerstone of successful trading. It's easy to get caught up in the excitement of the market, especially when things are going well, but discipline ensures consistency. A lack of discipline leads traders to deviate from their plans, ignore their stop-loss orders, or take on too much risk, all of which can result in significant losses. Traders who lack discipline may be tempted to chase quick profits, take unnecessary risks, or abandon their strategies when the market isn't behaving as expected. These actions are driven by emotion, not logic, and can cause traders to make costly mistakes. Link points out that one of the main reasons traders fail is that they let their emotions take control. Fear and greed are two of the most powerful emotions that can lead to impulsive decisions. Fear may cause a trader to exit a profitable trade too early, while greed may tempt them to hold on to a winning position too long, ultimately turning a profitable trade into a loss. Discipline is the antidote to both of these emotions. Creating and sticking to a trading plan. A major part of discipline is creating a detailed trading plan and following it to the letter. Link explains that successful traders don't just rely on luck. They have a clear plan that guides their trading decisions. This plan includes specific rules for when to enter and exit trades, how to manage risk, and how much capital to risk per trade. Once a plan is in place, discipline ensures that it is followed consistently. Link compares trading to a business. You wouldn't run a business without a plan, so why would you trade without one? The trading plan acts as a blueprint that tells you exactly what to do in every situation. But having the plan is only half the battle. The real challenge lies in sticking to the plan, even when emotions are high or when the market isn't behaving as expected. The importance of rules. Link goes on to emphasize the importance of rules in trading. Rules provide a structure for traders, helping them make decisions based on logic rather than emotion. For example, a trader's plan might include a rule to exit a trade if the market moves against them by a certain amount, e.g., a stop loss of 2%. This rule helps the trader avoid the temptation to hold on to a losing position in the hope that the market will turn around. Having specific rules also prevents traders from overtrading, which is another common pitfall. Discipline is needed to ensure that a trader follows their rules without exception. A single violation of the rules can have a cascading effect, leading to poor decisions and ultimately wiping out profits. For instance, if a trader ignores a stop-loss rule on one trade, it becomes easier to ignore it on subsequent trades, setting the stage for more significant losses. Managing emotional reactions. Link acknowledges that emotions will inevitably come into play in trading. Fear and greed are powerful emotions that can cloud judgment and cause traders to make impulsive decisions. However, he stresses that discipline helps manage these emotions by giving the trader a clear set of rules to follow, no matter the market conditions. By sticking to the plan, traders can avoid falling prey to emotional reactions and maintain a calm and focused mindset. One way to manage emotions is to create a trading routine. Link suggests that traders establish a set of pre-trade rituals to help them get into the right mindset before placing any trades. This might involve reviewing the market, analyzing potential setups, and reminding themselves of the rules they've established. These routines help traders stay grounded and focused, reducing the impact of emotions on their decisions. Discipline and consistency. Link stresses that discipline is not just about following rules, but also about being consistent over time. It's easy to stick to a plan when things are going well, but true discipline is shown when traders continue to follow their plan even during difficult times. Losses are inevitable in trading, but the key to success is staying disciplined and continuing to apply the same rules even when the market is challenging. Traders need to develop the mindset of long-term consistency, understanding that trading is a marathon, not a sprint. By sticking to their plan and consistently following the same rules, traders will eventually find success, as their disciplined approach will lead to positive results over time. Discipline in risk management. One of the most important areas where discipline plays a crucial role is in risk management. It's tempting to take large risks in an attempt to make up for losses or to chase big profits, but disciplined traders understand the importance of sticking to their risk parameters. A disciplined trader will risk no more than 1 to 2% of their capital on any single trade, regardless of how attractive the opportunity seems. By maintaining proper risk management, traders can weather the inevitable drawdowns and stay in the game for the long haul. Link advises traders to set stop-loss orders, use position sizing techniques, and limit their exposure to any one trade or asset. The role of patience. Patience is another critical aspect of discipline. Link explains that successful traders know how to wait for the right setup and don't rush into trades. They avoid the urge to trade out of boredom or frustration. Instead, they wait for the conditions to align with their strategy before taking a position. Patience is essential for maintaining discipline, as it allows traders to avoid impulsive decisions that can lead to losses. The dangers of overtrading. Marcel Link dives into one of the most common pitfalls traders face: overtrading. Overtrading is the act of taking too many trades, often driven by emotion, impatience, or the desire to make up for previous losses. Link warns that overtrading is not just about trading too frequently. It's about making poor, hasty decisions that negatively impact your performance. He stresses that quality, should always trump quantity when it comes to trading, and a focused, disciplined approach is key to long-term success. The emotional urge to overtrade. Link starts by acknowledging that traders are human, and as such, they're prone to emotional responses that can cloud their judgment. When the market is volatile, or when a trader has just experienced a loss, the urge to trade can become overwhelming. This is particularly true for those who feel like they need to recover their losses quickly. The desire to make money fast often leads to impulsive, ill-advised trades that would otherwise not fit into a solid trading plan. The root of overtrading. According to Link, one of the primary causes of overtrading is impatience. Many traders struggle to wait for the perfect trade setup and end up jumping into trades that are not part of their strategy. There's also the issue of traders becoming bored during periods of low volatility. When the market isn't moving, they might feel compelled to trade just to stay engaged, even when no good opportunities are present. This can lead to unnecessary risks and often results in losses. Overtrading can also stem from lack of discipline. Traders who don't stick to their trading plan may take extra trades in the hope of catching a winner or making up for a losing trade. However, this behavior is often counterproductive and erodes the trader's capital. The need to always be in the market can cloud a trader's judgment, pushing them to make decisions based on emotion rather than logic. The consequences of overtrading. Link warns that the consequences of overtrading are often severe. Trading too frequently can lead to increased transaction costs, including commissions and slippage, which eat into profits. Additionally, overtrading exposes a trader to more risk than they can manage. Taking more positions increases the chance of being wrong, and if the trader doesn't follow their risk management rules, the results can be disastrous. Overtrading can also lead to mental fatigue. Constantly monitoring the market and making decisions under pressure takes a toll on a trader's emotional and psychological state. This mental exhaustion can impair decision-making abilities, leading to further poor trades and even more emotional responses, creating a vicious cycle. The importance of patience and self-control. Link emphasizes that patience is a critical trait for traders. Waiting for high-quality setups instead of chasing every opportunity is one of the keys to success. Trading is not about how many trades you take, but how well you execute the right trades. Successful traders know how to wait for the market to come to them. They resist the temptation to act impulsively and are content with sitting on the sidelines until the right opportunity presents itself. This requires self-control and an understanding that not every market move needs to be traded. Quality over quantity. One of the main points Link makes in this chapter is that quality is far more important than quantity. A few well-executed trades with high probability setups will outperform numerous poor trades. Taking the time to carefully analyze a trade setup ensures that you're only entering positions that offer good risk-reward ratios. When a trader focuses on quality, they are more likely to follow their trading plan and avoid making rash decisions. Developing a trading routine. Link advises traders to establish a routine that includes taking breaks and staying disciplined about trading hours. Avoiding emotional trading is easier when a trader has a structured plan that involves knowing when to trade and when to step away from the screen. This routine should also include regular self-assessment to ensure that the trader is sticking to their strategy and not succumbing to the temptations of overtrading. One way to combat the urge to overtrade is by setting strict limits on the number of trades taken per day or week. By defining these limits in advance, traders can avoid the trap of taking unnecessary trades just for the sake of it. Additionally, Link suggests keeping a trade journal to track performance and identify patterns in behavior, such as instances of overtrading, which may lead to insights about improving discipline. The inner side of trading, keeping a clear mind. In the final chapter of High Probability Trading, Marcel Link delves into the psychological aspects of trading, emphasizing that maintaining mental clarity and emotional control is crucial for sustained success. Link argues that trading isn't just about having the right strategy or tools, it's also about managing your mindset. The way you think, feel, and respond to the market directly impacts your ability to make sound decisions. This chapter is all about understanding the inner game of trading and how to cultivate a mindset that supports disciplined, consistent performance. The power of mental clarity. Link starts by discussing the importance of mental clarity in trading. To make effective decisions, traders must be able to think clearly without distractions or emotional interference. A cluttered, chaotic mind leads to poor judgment, as emotions such as fear, greed, and frustration cloud the trader's ability to evaluate the market objectively. When you're emotionally charged, whether from a recent loss or a string of wins, it's easy to make rash decisions that deviate from your strategy. Clearing mental noise. One of the key points in the chapter is the idea of clearing the mental noise. Link suggests that traders should create a mental environment conducive to clear, calm thinking. This means eliminating distractions and taking the time to relax and center themselves before entering trades. In this state of mental clarity, traders are better equipped to follow their trading plan and make decisions based on logic and analysis, rather than being swayed by emotions. Link also mentions the importance of self-awareness in achieving mental clarity. He encourages traders to monitor their emotional state and recognize when negative emotions start to take over. If you're feeling anxious or frustrated, it's a sign that you might need to step away from the screen and reset before making any more decisions. In other words, mental hygiene is as important as physical preparation for a trader. Emotional control, the key to success. Another major aspect of keeping a clear mind is emotional control. Link highlights that trading is inherently emotional, but successful traders don't let emotions dictate their actions. Fear and greed are the two most powerful emotions that can sabotage a trader's success. Fear often manifests as a fear of loss, leading traders to exit positions too early or avoid taking risks. Greed, on the other hand, can lead traders to hold on to positions too long, hoping for more profits than what the market can realistically offer. By exercising emotional control, traders can make decisions based on their plan and rules, rather than giving in to the emotional impulses that often lead to mistakes. Link stresses that developing this emotional control is a process that requires constant practice and self-reflection. It's not something that can be mastered overnight, but with time, traders can learn to stay calm under pressure and maintain a steady mindset, even in the face of adversity. The role of focus and patience. Link also points out that focus and patience are essential for maintaining a clear mind in trading. A trader's ability to focus on the task at hand and avoid being distracted by market noise or outside influences is what separates successful traders from those who struggle. Patience plays a huge role in this, as traders must be able to wait for the right opportunities and avoid jumping into trades simply out of boredom or impatience. Link suggests that traders can improve their focus and patience by creating a structured daily routine that involves preparing for the day's trading session, reviewing the markets, and mentally rehearsing their strategy. This routine helps condition the mind for the disciplined approach required in trading. By following a set routine, traders can reduce the mental strain of constantly having to decide what to do next, which helps them stay focused and clear-headed. Building mental resilience. Another key point in this chapter is mental resilience, the ability to bounce back from setbacks. Link stresses that every trader will face losses at some point, and it's essential to stay resilient in the face of adversity. Successful traders don't let a loss define them. Instead, they view it as an opportunity to learn and improve. Developing mental resilience involves embracing failure as part of the journey and using setbacks as stepping stones to greater success. Link also suggests that traders should avoid dwelling on past mistakes. It's easy to get caught up in regret or frustration after a loss, but this negative thinking only serves to cloud the mind and distract from the task at hand. By focusing on the present moment and sticking to the trading plan, traders can maintain their emotional balance and mental clarity even after a string of losses. The importance of physical and mental health. Finally, Link highlights that a trader's physical and mental well-being plays a significant role in their ability to perform. Just as a physically fit athlete needs rest and recovery, a trader's mind needs time to rejuvenate. Link encourages traders to prioritize health, whether through exercise, meditation, or other means of mental relaxation. Keeping the body and mind in good condition helps traders maintain the energy, focus, and clarity needed to make sound trading decisions. Ultimately, the ability to keep a clear mind and control one's emotions is what separates successful traders from those who struggle. If you enjoyed this breakdown and want to dive deeper into trading, don't forget to like, share, and subscribe for more content that will help you level up your trading skills. Thanks for watching, and as always, trade smart and stay disciplined. See you in the next one.